The truth behind tax obligations for U.S. expats. Navigating taxes as a U.S. expat can feel like walking through a maze. With unique rules and requirements that follow Americans wherever they live in the world, it's easy to feel overwhelmed. Many expats are surprised to learn that the United States is one of the few countries that taxes its citizens on their worldwide income, no matter where they reside. In this guide, we'll break down the truth behind U.S. expat tax obligations, uncovering the key requirements, benefits, and strategies to help you stay compliant and avoid unnecessary stress. Whether you're a seasoned expat or preparing for your move abroad, understanding your tax responsibilities is the first step to financial peace of mind. I will help you understand tax obligations for U.S. expats. This includes foreign earned income exclusion and foreign tax credits. Key takeaways: understanding tax obligations for U.S. expats is essential to avoid penalties and fines. Foreign earned income exclusion can help reduce tax liability for U.S. expats. Foreign tax credits can provide relief from double taxation for Americans living abroad. Tax implications for Americans living abroad vary depending on individual circumstances. Seeking professional guidance is crucial for navigating the complex world of U.S. tax obligations for expats. Tax filing for U.S. expatriates requires careful consideration of treaty exemptions and other factors. I will explain tax obligations for U.S. expats in detail. I'll give you clear explanations and expert advice. This will help you understand tax filing for U.S. expatriates and the truth about tax obligations for U.S. expats. Understanding current U.S. tax requirements for expatriates. As a U.S. expat, knowing the tax rules is key. You must follow IRS requirements for expats and overseas tax responsibilities. The U.S. taxes everyone who is a U.S. citizen, even if you live abroad. The rules for tax residency for expats can be tricky, but it's important to understand them to stay out of trouble with the IRS. You might qualify for a special rule that lowers your U.S. taxes. Also, you can get credits for taxes paid in other countries to avoid paying twice. Explained: U.S. expats face U.S. taxes on all their income, no matter where it comes from. This can cause you to pay taxes twice. But foreign tax credits can help make this less of a problem. Recent changes in expat tax law. Foreign Earned Income Exclusion, FEIE. For the 2024 tax year, the FEIE amount has increased, allowing eligible expats to exclude up to $126,500 of foreign earned income from U.S. taxation. Standard deductions and tax brackets. Adjustments have been made to standard deductions and tax brackets for 2024, which may influence your taxable income and overall tax liability. Tax filing deadlines. U.S. expats receive an automatic extension to file their tax returns by June 17, 2025. Additionally, there are ongoing discussions about potential tax reforms. Ending double taxation. President Donald Trump has expressed support for ending the double taxation for Americans living abroad, though specific legislative changes have not yet been enacted. Tax obligations for U.S. expats living in Germany. Living in Germany as a U.S. expat means you must know the truth about tax implications for Americans living abroad. The U.S. tax system is very complex. Not following the rules can lead to big fines. One key part is reporting foreign assets to the IRS. This includes money in banks, investments, and more. The U.S. and Germany have a tax treaty. This treaty helps U.S. expats avoid paying taxes twice. Knowing how this treaty helps you is key to paying less in taxes. By using the treaty's rules and reporting foreign assets to the IRS right, you can meet your U.S. tax duties while in Germany. It's very important to talk to a tax expert. They can guide you through the tax implications for Americans living abroad. They make sure you follow all U.S. tax laws, maximizing the foreign earned income exclusion. As a U.S. expat, it is important to understand the foreign earned income exclusion. It lets taxpayers exclude certain amount of gross income they had earned abroad on their U.S. tax return. This can really lower what they owe in taxes. To get this exclusion, you must pass one of two tests. The first is the physical presence test. You need to be in a foreign country for at least 330 full days in a year. The second test is the bona fide residence test. You must live in a foreign country for a whole tax year. Calculating your exclusion amount. To figure out how much you can exclude, you need to know how much you earned abroad. Then, you apply the exclusion limit. For 2024, this limit is $126,500. It's very important to get this right to follow U.S. tax rules and save on taxes. Physical presence. Test requirement. The physical presence test is one way to qualify for the exclusion. You must spend at least 330 full days in a foreign country in a year. This test is good for people who work abroad on a job or project. Navigating foreign tax credits for double taxation relief. As a U.S. expat, I know how important it is to pay less in taxes. Foreign tax credits are a big help. They let you use taxes paid to another country to lower your U.S. taxes. This helps avoid double taxation, a big problem for expats. To use foreign tax credits right, you need to know how they work. The U.S. gives these credits to help expats who've already paid taxes in their home country. By using foreign tax credits, you don't have to pay taxes twice on the same money. This stops double taxation. Here are important things to think about with foreign tax credits. You can claim credits for taxes paid to another country. Foreign tax credits help lower your U.S. taxes. They help avoid double taxation with good planning. Using foreign tax credits and knowing about double taxation can really cut down your taxes. It's very important to get help from a tax expert. They can make sure you're using these tax benefits the right way. Understanding U.S. German tax treaty benefits. The USA Germany Income Tax Treaty provides several benefits to individuals, aiming to prevent double taxation and promote clarity in cross-border tax matters. Here are the key benefits. 1. Avoidance of double taxation tax credits. U.S. taxpayers living in Germany, or vice versa, can claim foreign tax credits to offset taxes paid in the other country. Exemption method. Certain types of income, like pensions or specific earnings, are taxed only in the country of residence, depending on the treaty's provisions. 2. Lower tax rates on certain income dividends. Taxed at a reduced rate of 5% to 15%, depending on the percentage of shares owned. Interest income. Often exempt from taxation in the source country or subject to a lower rate. Royalties. Limited taxation in the source country, reducing the overall tax burden. 3. Relief for cross-border workers' income allocation. Cross-border workers, remote employees or temporary assignments, only pay taxes in the country where they are working for specific time periods or income thresholds. 4. Protection against discrimination. Ensures that citizens and residents of either country are not subject to discriminatory taxation practices in the other country. 5. Pension and Social Security benefits. Retirement income is typically taxed only in the country of residence. Social Security benefits may be taxed solely in the country of origin, depending on the specific type of benefit. These treaty benefits simplify tax compliance for individuals living or working between the U.S. and Germany and help reduce the financial burden of international taxation. Essential reporting requirements and forms. As a U.S. expat, knowing the key reporting needs is vital. You must report foreign assets to the IRS. This includes filing the FBAR and Form 8938. These forms help the IRS know about your foreign money. This includes bank accounts and investments. It's important to fill them out right and on time to avoid trouble. FBAR filing guidelines. The FBAR is filed by itself and is due on April 15th and has an automatic extension to October 15th. You need to file it if your bank account balances is or exceed $10,000 at any point in the year. Form 8938 requirements. Form 8938 goes with your tax return. It's for reporting certain foreign assets. You must file it if your foreign assets are over a certain amount. This amount changes based on your status and where you live. Single or married filing separately. Total value of foreign assets exceeds $200,000 on the last day of the tax year or $300,000 at any point during the year. Married filing jointly. Total value of foreign assets exceeds $400,000 on the last day of the tax year or $600,000 at any point during the year. Knowing and following these IRS requirements for expats helps you avoid penalties. It's wise to talk to a tax expert to make sure you're not missing anything. Managing your U.S. tax obligations from abroad. Living in Germany as a U.S. expat can make tax rules seem overwhelming, but with the right help, you can manage your U.S. taxes. Take advantage of the foreign earned income exclusion and foreign tax credits. Also, the U.S. German tax treaty can help prevent double taxation. Don't forget to meet filing deadlines and report the FBAR and Form 8938. Understanding the truth behind tax obligations for U.S. expats is crucial to staying compliant and avoiding unnecessary penalties. While the U.S. tax system's global reach can seem overwhelming, knowing the rules, leveraging tax credits and exclusions, and utilizing treaty benefits can significantly reduce your financial burden. Staying proactive by seeking professional guidance and staying informed about changing regulations ensures you can confidently navigate your expat tax responsibilities. Whether you're living abroad temporarily or permanently, clarity about your obligations empowers you to focus on enjoying your international journey with peace of mind.